What is Elliott Wave Theory, and how to use it in crypto? Elliott Wave Theory offers a method for analyzing market cycles and predicting price movements in the crypto market. Elliott Wave Theory predicts prices in all sorts of markets, allowing investors to adjust their trading strategies based on historical trends. If you're new to our channel, then subscribe and stay connected with us by like, comment, and share this video. What is Elliott Wave Theory? Elliott Wave Theory is a price prediction model established by the accountant Ralph Nelson Elliott in 1934. The model is based on a common pattern Elliott discovered while studying the history of stock market price patterns. What Elliott found was that price movements moved in up and down waves, broken up into groups of 5 and then 3. The first set of 5 waves results in an overall positive trend. Wave 1, wave goes up, setting a new trend. Wave 2, wave goes down, correcting against the trend. Wave 3, wave goes up with the trend, higher than before. Wave 4, wave goes down, correcting against the trend set by wave 3. Wave 5, wave goes up, reaching a new peak. The price movement will peak at the end of this set of 5 wave counts and begin to drop, leading to an overall negative trend. According to Elliott Wave Theory, the movement will drop in a set of 3 waves. Wave 1, wave goes down, correcting against the trend. Wave 2, wave goes up a bit, retracing some of what was lost. Wave 3, wave goes down, correcting against the trend. From here, Elliott claims the 8-wave principle will repeat, leading back into 5 waves, converging into 3 waves, and so on. Elliott argues that these market cycles can be seen across various time frames, that the 8-wave theory applies in a 15-minute trading period to an hour-long period to a week-long, and so on. How to use Elliott Wave Theory while trading in crypto. When using Elliott Wave Theory to trade in the cryptocurrency market, it's important to note that the patterns may initially be difficult to see. They are rarely a perfect portrayal of Elliott's theory. However, Elliott has a few rules in place to help visualize trading patterns. Note that Wave 2 will never retrace all of Wave 1's gains. Wave 3 will almost always be higher than Wave 1 and should never be the shortest of Waves 1, 3, and 5. Wave 4 should be lower or equal to Wave 1, as that would mean it retraced all of Wave 1's gains. Considering these rules, investors can confidently approach a crypto trading chart. That said, here's how the theory can be applied through visuals. Detect whether or not the primary trend is made up of bullish waves or bearish waves. Label the waves to visualize the patterns. Utilize other trading indicators, such as the Relative Strength Index, alongside the Elliott Wave Oscillator, a built-in wave reading tool for most charts. Please note that waves can last for days, weeks, or even years. The length of these waves is known as wave degrees. The above chart provides an Elliott Wave analysis of Bitcoin's price movement from October 2022 to April 2023. It suggests that Bitcoin experienced a significant bullish trend from December 2022 to April 2023. However, the divergence and momentum reversal indicators, along with the irregular correction in Wave 4, raise caution for traders. These signals might indicate a potential weakening or reversal of the bullish trend. Moreover, please be aware that Elliott Wave Theory is a subjective form of technical analysis, and interpretations can vary. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.